Most people want to be financially independent. Having enough cash on hand, savings, and investments to support the lifestyles we want for our families and ourselves is one definition of financial independence. It entails making sacrifices in terms of money so that we can pursue our ideal jobs or retire without feeling under pressure to earn a specific amount of money each year. To become financially independent, we must have the ability to use money not against us but for us. To attain financial freedom, you must pay off your consumer debts, build a safety net of savings, and produce enough passive income from investments or business ownership to cover your present and anticipated future living expenses. In this video, we will have a look at the top 10 steps to financial freedom. Before starting, don't forget to like and subscribe to our channel for future updates. Let's start. Number 10. Track your spending. Monitoring your expenditure is one of the most crucial stages toward financial freedom. You can use a variety of internet applications. These tools will provide you with specifics regarding your spending habits, areas where you frequently overspend, the total amount of money in all of your accounts, and your debt load. Many of them offer user interface goal-keeping components that could aid in your ability to maintain concentration. Number 9. Learn what must be learned. Keep up with news and events in the world of finance, and don't be hesitant to adjust your investing portfolio as needed. Knowledge is the best line of protection against those that prey on unwary customers to make quick cash. When using your credit card, be mindful of your credit limit to avoid exceeding it. You must keep up with any changes to this material. Number 8. Bargain. Due to their perception that doing so makes them appear cheap, many Americans are hesitant to haggle for goods and services. There are many foreigners who provide advice to Americans on how to bridge this cultural gap. You might end up saving several $1,000s a year. Smaller merchants in particular are typically open to dialogue. Buying frequently or in large numbers may result in significant savings. Number 7. Invest. The only method for boosting your money that has been scientifically demonstrated to work is investing. Research and comparison of the two options should be done in order to choose whether you want to begin with an IRA or a 401k but start. That is the step that is most important. Number 6. Monitor your credit. A person's credit history has an impact on any interest rates for credit cards, store cards, vehicle, truck, or house loans or refinances. Prices for life and vehicle insurance are two of those that are impacted. The argument holds that someone who engages in financial irresponsibility may also engage in other detrimental activities like driving while intoxicated. In general, those with bad credit have more accidents and submit bigger insurance claims than people with good credit. This is not intended to suggest that having bad credit automatically makes a person a bad driver, just as being a single guy of age 23 does not guarantee bad driving. He will have to pay higher monthly rates because he is young, single, and a guy. Poor credit is one of the several risk pools that insurance companies consider when determining your monthly rate. Number 5. Save. Pay yourself first. That is a regular recommendation from financial experts. Enroll in the retirement plan offered by your company, and make use of any match-able contribution opportunities. Setting up automatic donations from your employer to an emergency fund that can be utilized for unforeseen needs is another excellent suggestion. Consider establishing an individual retirement account and adding an automated brokerage contribution. However, keep in mind that the ideal quantity to save is debatable and that a fund of this kind might not even be required depending on the circumstance. Number 4. Invest in your future. The final tip is crucial for achieving financial freedom. Let's assume you follow the suggestions and advice in this article, pay off your debt, and increase your savings. That might be sufficient to assist you at this time, but what if something unexpected occurs? Are you going to be ready for it? Saving money is necessary for retirement, unforeseen costs, and other contingencies. Regardless of whether you work a 9-to-5 job, ask your employer if they can add a retirement plan or see if they already deduct money from your pay for one. Since the deduction is made before the money leaves your account, you never feel like you are losing money. It's also a lot of fun to check in on it occasionally to see how your funds are doing. Start putting money away for an emergency fund as a next step. The appropriate amount is either $10,000 or 6 months' worth of your salary, depending on the expert. And to be honest, if you don't make a lot of money, these amounts could seem excessive. Start with a modest objective instead, like $100 for the first month. You can start increasing your target to $500 per week, $500 per month, and so on if your income rises. Don't use your emergency funds to settle the bill if you've overspent. Instead, focus on finding additional sources of active income to help you pay it off more quickly. Only unanticipated catastrophes, such as a tree falling on your house, a car accident with associated out-of-pocket expenses, or a trip to the hospital, should be covered by the emergency fund. Less probable will it be that you experience the same situation as you do now, wishing for financial independence, if you save aside money for retirement and unplanned expenses. Number 3. Abundant assets. Financial freedom is typically made possible by assets like cash in bank accounts, stock investments, and expensive real estate. Before using such assets in the process of gaining financial freedom, you must first invest in them, frequently in the form of enormous sums of money over a long period of time. To preserve your long-term security and stability, for instance, the majority of financial consultants would suggest that you constantly make contributions to your 401k. This may be true for many people if they start investing in their 20s or 30s. However, people who wait until they are at least 50 years old to begin investing won't have enough time to take advantage of compound interest. Typically, their contributions won't alter even after accounting for inflation. There may be problems while using assets to obtain financial independence. Think of it as a tricky balancing act. You will have to sell an asset in order to have enough money to make your payments if you adopt this technique to pay for your requirements and wants. There can be problems if you can't swiftly sell an asset, like real estate, for example, to acquire the money before your bill's due date. These individuals are sometimes referred to as cash-poor millionaires. Even though they have assets worth more than $1 million, they are unable to use them quickly enough. Another, potentially more significant problem arises when you run out of assets to sell for cash before you pass away. In essence, you won't have enough money to pay your debts if you spend through all of your assets too soon. The majority of stable homes combine the two of these tactics. They likely also receive independent income from sources like Social Security, a business, or dividend-paying investments. They have made, in addition to having built sufficient assets in the stock and real estate markets. They feel more secure financially since they are aware that they have a variety of resources at their disposal in the event of an emergency. Number 2. Budget. A monthly household spending plan must be created and followed to guarantee that all bills are paid. Investments are made as intended, and the growth of independent income is proceeding as expected. Regularly making a budget will strengthen your commitment rather than giving in to impulse purchases, and it will assist you in sticking to your goals. Credit cards and consumer loans with high interest rates are obstacles to your efforts to amass wealth. Review the 5 basic budgeting guidelines for extra information. Number 1. Independent income. Independent income describes sources of consistent income that you may rely on without having to work, such as a business, government benefits, or other sources. If you are eligible, Social Security benefits are paid each month. If your business has developed to the point where you can stand back from day-to-day management, you can still be compensated regardless of the amount of time you put in. If you own a rental property, you get paid rent once a month even if property management routinely asks. Upkeep of the property and carries the risk of renting to a tenant who misses one or more payments. If you make enough money on your own to meet both your needs and your wants, you are considered financially independent. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe our channel for future updates. Thanks for watching.